Every toll you pay, you are giving money to someone. You know that. What you probably don't know is who that someone is, because there's a good chance it's not your government. In 1999, Ontario sold the 407 Express toll route, a highway the province had built with public money, to a private consortium for $3.1 billion. Spanish infrastructure company Ferrovial and a group of investment funds were the buyers. The deal gave them a 99-year concession, 99 years, to bill Ontario drivers whatever they want, because the contract has basically no rate caps. Since 1999, the toll rates on the 407 have risen by more than 300% in real terms. The consortium has gathered billions. Ontario drivers have been complaining for 20 years. And the government that sold it out can't do anything about it because they signed a contract that runs until 2098. That deal remains one of the most regretted infrastructure deals in Canadian history. And this is not the only one. North American, European, and Australian governments sold, leased, and concessioned bridges, tunnels, and highways to private operators at prices that seemed attractive at the time and look very different in hindsight. Today, we'll dig into how these assets actually work, who owns the big ones, what the economics look like from the owner's perspective, and why the people on the paying side of the toll booth tend to end up worse off than the people who built the booth. Every toll you have paid has helped someone make a more profitable investment. Subscribe. And every week, I will tell you who are the real owners of these megastructures. What makes these things attractive to private investors in the first place? Let's start with that. Because the pitch is not complicated, and when you hear it, it is difficult to argue with the logic, even if you dislike the result. A major bridge or tunnel crossing a major geographic barrier has something that almost no other asset has: a captive user base with no practical alternative. If you're crossing the English Channel over land, you're going through the channel. Or you're not going. If you're driving from New Jersey to Manhattan through the Lincoln Tunnel, you either pay the Port Authority or you take a different route, and the different routes are also congested and also have tolls. The geographic constraint is set. There is no rival tunnel under construction under the channel. This is what infrastructure investors refer to as a natural monopoly. Not a monopoly because a company drove out competition, but a monopoly due to physical geography. It is a unique asset, it is irreplaceable, and every vehicle using it is generating revenue. Ever. Or 99 years, which for all practical purposes is the same. The Channel Tunnel cost some £15 billion to build in the early 1990s, more than double the original estimate. The company that built it, Eurotunnel, has undergone 2 financial restructurings. But the physical asset kept generating revenue throughout it all, because trucks and passengers still needed to cross the channel. The tunnel outlived the financial edifice that built it. This pattern is consistent in large infrastructure. The original builders tend to go bankrupt or suffer serious setbacks. The asset gets bought out at a discount by new investors who then collect cash flows for decades. The 407 in Ontario, the Chicago Skyway, the Indiana Toll Road, the Pocahontas Parkway in Virginia. They all were sold or passed to investors who received the asset after the hard part was done. The hard part is making it. Operation is the profitable part. And the split between who builds and who benefits is the heart of infrastructure economics. The revenue model for a toll bridge or tunnel is embarrassingly simple. Cars are coming. They pay. You gather. The devil is in the details. The concession structure, the rate-setting mechanism, the traffic volume assumptions, and the financing stack under the whole thing. The rest is dependent on this initial assumption of traffic volume. You model 100,000 vehicles a day, and you get 80,000. Your revenue is 20% less than you thought, but your debt service and operating costs are pretty much the same. That gap can make a profitable project into a problem. This is exactly what happened to a number of toll road concessions, especially those signed in the mid-2000s based on optimistic traffic forecasts after the 2008 financial crisis slammed vehicle miles traveled in ways no one had modeled. The Indiana Toll Road concession went bankrupt in 2014, not because the road stopped working, but because traffic didn't rebound to forecasted levels fast enough to service the acquisition debt, $83 billion. The money was used to fill budget gaps in the city, $5 billion for their share. Toll road fees have gone up. The pension funds are pooling. $83 billion. The financing structure on these deals is very leveraged. Most large bridge and tunnel acquisitions are financed with a relatively small amount of equity and a large amount of project debt secured by the toll revenues themselves. This leverage magnifies upside when traffic meets expectations and bankruptcy risk when it doesn't. The equity investors get the upside. The toll income is pledged to the debt holders. When things go wrong, everyone downstream of them, including the government and the drivers, has little recourse. Your toll road is owned by pension funds, and they make money each time you pass through the toll booth. If you like this and want to see how it works, subscribe. The ownership map of major bridge and tunnel infrastructure has consolidated significantly over the last 20 years, and the names you see repeatedly are mostly the same ones from the pipeline, airport, and port episodes. The Port Authority of New York and New Jersey operates the George Washington Bridge, the Lincoln and Holland tunnels, and other important crossings. It is a public agency, but its finances operate more like a regulated utility than like a typical government department. The GWB is the world's busiest bridge in terms of vehicle count, some 100 million crossings a year. That's over $1 billion a year in toll revenues from one bridge at current toll rates. The Port Authority uses that revenue to cross-subsidize the Paige train and the region's airports, which is why the GWB toll is as high as it is, and why the people that drive it are always fighting about it. I see this pattern a lot, and I think it is underappreciated. The financial history of big infrastructure assets nearly always includes at least one catastrophic failure by the original builders, purchase at a discount by investors with longer time horizons, and decades of steady cash flows. At first, the threat was real. When the financial institutions are collecting, the risk is largely historical. From the outside, toll infrastructure looks like a free money machine. No, not quite. The risks are there. They just aren't the risks most businesses have. The biggest one is traffic risk. You make your money based on how many vehicles cross your crossing. A new competing route. A major employer shutting down near your facility. Remote work reducing the frequency of commutes. Fuel prices hitting a tipping point that changes travel behavior. Any of these can shift your traffic numbers in ways that are hard to predict over a 30 or 50-year concession. Political risk is harder because it is less quantifiable and less hedgeable. The most obvious case is that of the 407 in Ontario. The concession contract allows pretty much unlimited toll increases, which was not obviously controversial when the contract was signed in an era when the highway had low traffic and people were focused on the upfront cash. 30 years later, it's a political football that every Ontario politician talks about, and none of them can actually do anything about because the contract is the contract. This is where I keep getting hung up on toll infrastructure. The assets are real. The economics work, and private capital has done in many cases a better job of maintaining and operating these crossings than public agencies that built them. The Channel Tunnel exists and works, and probably would not have been built so quickly or so well under pure government management. 407 in Ontario is a good highway, moves traffic well, and is well maintained. But the rate structures in many of these deals are really unfair to the people who have no choice but to use them. Not unfair in a conspiracy sense. Unfair in the sense that a contract negotiated between a government and a sophisticated infrastructure consortium, with the government usually under budget pressure and the consortium with a team of specialized lawyers and financial modelers, is not a negotiation between parties with equal information or equal leverage. The government wanted cash up front. The consortium wanted cash flows forever. They both got what they wanted. The drivers received what the contract stipulated for tolls. From my point of view, however, the solution is not clear. Governments that directly own and operate toll infrastructure face their own challenges. Political pressure to keep tolls artificially low, deferred maintenance, and competition for budget with other priorities. Consider the Port Authority of New York and New Jersey. It has enormous revenues, but also a persistent infrastructure backlog. Here, public isn't automatically better than private, but at least you have to know who owns the toll booth and why the toll keeps going up so that you can bitch at the people who own the toll booth. And that appears to be the bare minimum. Subscribe, I upload videos every week. You know where we are. See you soon in next vid. What's the most controversial toll road or bridge in your country? Tell me about it in the comments.